Everyone's told you that the 4% rule is the safe withdrawal rate, but in a recent article from Morningstar, their latest math says 3.7%. And the problem is that by following these or any other retirement plan built on fixed withdrawal rates, is that those assumptions could steal 5 years or more from your retirement. So let's take them back. In this video, I'll walk you through why the 4% rule is failing you and what changed. 3 smarter withdrawal strategies that have proven to be both popular and effective, as well as a short case study for each rule so that you could see what it could mean for you in practice. Because the truth of the matter is that while fixed rates like 4% can be a quick, easy hack to figure out if you're on track, in practice, the truth is that it often means you end up dying with hundreds of thousands, if not millions, more than you actually needed. And if that's what you're truly after, then this video probably isn't for you. But what if you're looking for an alternative, a way to get more time out of your money, a way to plan confidently without being stuck to a rigid withdrawal rate, whether that's 4%, 3.7%, or something completely different, so you can sleep peacefully at night? I'm John Norberg, certified financial planner and founder of Norberg Wealth Management. And if any of what I've just said sounds like you, then you're going to want to watch this latest edition of the Financial Prof series. Since it was invented in 1994, the 4% rule was considered the gold standard. You take 4% in year 1, adjust for inflation each year, and historically you'd make it 30 years, if not longer. Now that guidance came out of a different world. Higher bond yields, different inflation dynamics, shorter retirements on average. Fast forward to today, and interest rates have moved around. Market sequences can be tougher earlier in retirement, and healthcare costs have more than tripled. Not to mention longevity has expanded. The math that made 4% forever feel safe doesn't map cleanly onto modern retirements. Even Morningstar's own 3.7% change is a big signal. We can end up over-delaying, under-enjoying what we might be ready for now. And that's the painful part. Being too safe doesn't just trim spending. It can cost you entire years, those healthy, active, early retirement years when the trips, the grandkid weekends, the afternoon golf rounds actually matter. So if fixed is the problem, what's the alternative? To answer that question, I'm going to walk you through 3 adaptive strategies that flex with markets and your life. Let's get into them. So the first strategy is variable withdrawals, that is, flex with the markets. When markets are strong, you allow yourself a little more. When markets dip, you temporarily tighten the belt. And the flexibility is the feature, not the bug. You see, instead of locking in 4% plus inflation every single year, you set a reasonable range for spending and adjust annually based on what your portfolio just experienced. In fact, this strategy is so popular, you've probably already heard of it. But there are a number of varying opinions on what the reasonable range of withdrawals should be, and getting it wrong could prove catastrophic. Quite honestly, this is part of why working with a financial advisor can be so important. But suffice it to say that when defining that band for withdrawals, it needs to be reasonable enough to where you'll actually follow it when, not if, the markets decline. So there are several ways to do this: percent of portfolio, moving averages, or guardrail light adjustments. But the theme is the same. You ride the tailwinds, ease off in the headwinds, and protect the portfolio from deep, early depletion. One of the biggest dangers to your portfolio early in retirement is sequence of returns risk. Bad returns your first few years while you're drawing income. Variable withdrawals act like a shock absorber. You avoid compounding the damage you'd experience if you'd pulled from the same or more dollars from a temporarily depressed portfolio. So by way of example, let's take Lisa. She's 63, has $1 million, and planned to retire at 65. Under the 4% rule, she'd take out $40K per year, adjusted for inflation. But that plan doesn't bend when markets drop, and rigidity early on can sink an otherwise solid plan. So we can model Lisa's withdrawals with a variable range, say 3.4 to 4.6%, depending on market performance. Here's what happens. In strong years, like her first 2 years of retirement, she comfortably withdrew about 45 to 46K, enough for her 2 dream hiking trips. During down markets, let's say year 3 saw a 12% market pullback, she tightened spending to 34K, skipping 1 trip and saving her portfolio from deeper damage. Because her spending flexed, her portfolio rebounds faster, and she's back above $1 million even after withdrawals. That flexibility can also save the success probability, meaning that it goes up meaningfully higher and she can retire 2 years earlier than planned. So Lisa didn't have to sacrifice her adventures. She just plans them in sync with the markets. Flexibility turns 2 more years of work into retire now and still climb those mountains. All right, so let's talk about strategy number 2, Guyton Klinger's guardrails. Named for its inventors Jonathan Guyton and William Klinger, the guardrail system sets a lane for your spending. If markets in your portfolio do well, your paycheck goes up. If the portfolio slips below a threshold, you trim temporarily. The rules tell you when to adjust, so you're not guessing or panicking. Imagine your spending is a car and your portfolio is the road. Guardrails keep you centered. You start with an initial withdrawal rate that fits your plan, then you set upper and lower thresholds. If your portfolio rate drifts too high because markets fell, the rules say tap the brakes. If the portfolio drifts too low because withdrawal rate drifts too low because markets did great, then that's when you hit the gas and enjoy a raise. So why does this help? Because it removes emotion from the decision. You're not white-knuckling decisions every January. The preset rules are evidence-driven and have been tested across tons of market scenarios and histories. Behaviorally, it's easier to follow a rule than to constantly renegotiate with yourself. So let's talk about George and Amira. They have $1.4 million between a 401k and an IRA, and they want to spend about $65K per year. Using a flat 4% rule, they'd have about $56,000 to spend, but they were terrified that a market dip would force them to cut back permanently. By implementing the guardrail system, we start with a 4.5% withdrawal, $63,000 in year 1, and build automatic adjustments. If the market dropped enough to push their withdrawal rate above 5.5%, they can reduce next year's spending by 10%, down to around $57K. If the market surges, bringing their withdrawal rate below 3.5%, they can give themselves a 10% raise, up to $69K. And here's the beauty of it. Over 20 years of simulated returns, their average withdrawal rate hovers around 4.6%. But in great years, they get to spend up to $70,000 plus without hurting the overall success. In fact, their success rate, according to Monte Carlo, moved into the mid-90s. Because this plan gives them permission to retire a full year earlier, knowing that the system, not emotions, would tell them when to ease off or celebrate. So guardrails don't just protect portfolios, they can protect confidence. With clear rules of the road, George and Amira are finally able to stop white-knuckling their finances and start enjoying those late morning coffees on the porch even sooner. So allow me to pause for a moment. If you're watching this thinking, wait, could I have already retired? You might be closer than you think. I'm offering a free 5-minute personalized retirement video where I walk you through your numbers and show you how a few tweaks might help you buy back years of freedom. No sales pitch, no meeting, just a quick, clear walkthrough of your numbers. And if you want one, you can hit the link below and request your free 5-minute retirement plan video. I'll send it straight to your inbox. All right, back to the strategies that make this possible. Our third strategy is Michael Kitces' ratcheting strategy, which rewards success permanently. With this strategy, you start reasonably conservative, then permanently raise your withdrawal rate after strong performance. It's a formal reward for success, so you don't end up living far below your means after good years. Many retirees, you see, never give themselves a raise, even when their portfolio earns it, because they're afraid to jinx it. The ratcheting approach, however, builds the raise into the rules. If your portfolio surpasses a defined growth threshold after withdrawals and inflation, you bump that withdrawal rate up a notch. It keeps your lifestyle aligned with your actual results. Now this can help because it avoids that risk of dying with millions more than you wanted or needed to, and a plateful of regret along with it about working too long. The ratchet rule turns portfolio success into memories while you're most able to enjoy them. So let's look at Nina and Marco. This couple were textbook savers, $1.2 million saved away, plus light consulting work that they planned to phase out at age 65. They also had the benefit of a pair of pensions. But despite all of this, they were still scared to touch the money. The fear of what if was paralyzing them and robbing them of years of their life. So by implementing a ratcheting rule, we start at a conservative 3.7% withdrawal, $44K. If after withdrawals and inflation, their portfolio grows by 10% or more, they ratchet up their permanent withdrawal rate by 0.2%. So by year 3 in our scenario, markets had been kind. Their portfolio climbed to 1.25 million after withdrawals. The ratchet triggers, lifting them to 3.9%, bumping annual income to 52K. By year 7, they're already at a strong run at 1.5 million, meaning they can take 4.1% or 61K per year. And in fact, they talked about using that raise to book their long dreamt of Italy vacation. And the fact is, it doesn't harm overall the success rate when we run it through the software. In fact, they too found that their overall probability of success was over 90%. And it allowed them not to die with millions of dollars and a plate full of regrets. So ratcheting gives Nina and Marco the confidence to enjoy their wealth, not hoard it, rewarding success with freedom, and then letting them live their healthiest, most adventurous years to the fullest. So, let's do a quick recap. Variable withdrawals are simple flexibility. Spend a bit more after good years, ease off after the tough ones. Great for independent DIYers who can live with ranges and want built-in shock absorption, but make sure you get the band right. Guideline or guardrails. Systematic rules that tell you when to adjust up or down. Perfect if you want clarity and accountability without constant decision fatigue. And finally, Kitsis's ratcheting. Starting conservative and rewarding success with permanent raises. If you're prone to oversaving and want permission to enjoy those wins while you're still able to, this is probably the rule for you. But the truth is, the best method is the one you'll follow consistently because it matches your temperament, your vision, and your lifestyle. Most people, you see, don't fear running out of money as much as they fear wasting their only truly limited asset, time. They fear waking up at age 74 and realizing they could have retired at 67 and didn't. And that isn't a math problem, it's a strategy problem. Rigid rules can create rigid lives. Adaptive rules can create options. And that's the whole point. Options. The option to take your grandson to his first baseball game on Tuesday, or to finally get to those books you've been meaning to read over a nice cup of tea. The option to book the trip while stairs are still easy and your knees say yes. So here's the real takeaway. Following fixed withdrawal rates like the 4% rule hasn't just cost people money, it's cost them time. Because in the end, the portfolio withdrawal rate, it's just one of many inputs into a comprehensive drawdown strategy, which ought to include taxes, insurance, housing, dependent care, life expectancy, estate planning, and a number of other variables. If you stick to a fixed number, it's far less important than having a plan with flexibility for the multifaceted scenarios that life throws at us. If you're wondering how these strategies might work for you, the first step is to get an understanding of where you are today so you can dream with intention about tomorrow. Which is why, if you click the link below, I will personally record you a free 5-minute retirement plan video walking through your numbers so you can have that kind of clarity. If you want one, hit the link, request that free 5-minute retirement plan video, and I will send it right to you. You can't go back and retire 5 years earlier, but you can make sure you don't wait 5 more. The right plan doesn't just protect your money, it gives you your time back. Thanks for watching. If you found this helpful, I would encourage you to check out our other Norberg Wealth Management series videos, and in the meantime, I'll see you out in the next one.